Hello and welcome to this episode of Money View from the Top. Joining me today is an industry veteran, someone who has vast experience in wealth management and mutual funds, Vishal Kapoor, who is the CEO at IDFC Asset Management, one of India's fastest growing and leading mutual fund houses. Thank you very much, Vishal. It's a pleasure talking to you. I've tracked your journey for many, many years. These are very interesting times we live in, isn't it? Had we spoken maybe 2 weeks ago, this interview would have started on a fairly bearish note, but things seem to have dramatically changed. How are you reading the markets at this point of time?
Firstly, thanks a lot, Vivek. Always a pleasure to speak to you, and thanks for having me on this show. And you're absolutely so right that, just a couple of weeks in the market, sometimes just a couple of days, can have such a big swing that it reminds us the need to keep going back to basics in so many other ways, right? I think, we try and obviously make as much sense of the market as we can. I can't say we succeed all the time. But it's very important, I guess, both as money managers as well as investors to, I guess, not get so close that you miss the broader, the bigger trend as well as opportunity. And sometimes, therefore, it's healthy enough to keep a bit of distance and look at, what's happening at a macro level. And, hopefully that gives us a better sense of how to position products, what sort of opportunity to really focus on and look at. And clearly in every market, we see that there are enough and more of those. So it's important to not miss out on some of the bigger ones.
Vishal, we went from 62,000 on the Sensex all the way down to 51, 52, and everyone said we've entered a bear market. In just the last few days, we've, at the time when we are recording this interview, we are at above 58. Would you call this a return of the bull market? Because again, the commentators, seem to suggest, most commentators seem to suggest that, we are back in a bull market. And but at the same time, there are many who are saying that this is just a small blip. From an investor's point of view, a retail investor's point of view, how should she or he be reading the sudden pull up that we've seen in the last few days?
Right. And I think that's a very important thing Vivek look at, which is that clearly in the last month or so you've seen a very sharp rebound. A lot of it is being attributed to the fact that you already had in the market fairly robust domestic flows, both from retail investors as well as domestic institutions, etc. And what may have been missing for several months before that was the FII flows. And the moment you have now some data which suggests that FIIs may be back, or even if they stop selling, that can often result in a bit of a rebound. So in some sense, there is the immediate liquidity, which can lead to the perception of the market rebounding a bit. And maybe part of that, could have happened over the last month or so. What's important, I guess, like we spoke earlier, is to keep in mind, what's the macro context we are in. And let's not take our eye off the ball that global economy is slowing down. And in most parts of the world, especially in the developed markets, one should not be very hopeful of high growth rates that many economies have seen in the last cycle. So when you're looking at 2, 3, 4% growth rates in the bulk of the world, one has to be therefore a bit cautious about what sort of expectations from markets are we building in. And, therefore, look at any of these bounds in that context, if I may. Now, having said that, and clearly, I guess we've all seen the concept of, the liquidity injection that the world had to be, or most central banks gave the world post the COVID outbreak, and making sure that the economies across the world do not completely fall off. And some of the after effects of that injection resulting in very high inflation, and now the effect of trying to slow down, curb that inflation through interest rates hike, and the slowing economy across most parts of the world, maybe as a culmination of all of these factors, as well as the cyclical sort of trend you had even before COVID, resulting in the peculiar situation we are in. Having said that, while there are all of these negatives, commodity prices, the war, slowing growth, the India picture does look remarkably different, and that's something that we have to keep in mind. When you look at therefore the Indian market, one has to also look at the fact that earnings have been quite strong, and the inflation scare or the worry that most central banks would have may not be as much of a deviation from the sort of target for us. So, for example, for most of the other developed markets, when your targeted inflation may be in the 2% odd band and you're at 7 to 9%, you're way off. And therefore, the amount of, action you have to take to rein in inflation is going to be very severe. For the RBI here, a lot of factors have led to that, of course, but you're really talking about 7% inflation versus a band of up to 6. So the level that you have to, correct may not be as much. So India is unique. India is far better, and therefore some amount of buoyancy in India may be expected. But we have to keep the global context of the fact that you are getting into a slowing economic growth phase across the world, and therefore expectations have to be modest.
Vishal, you've had a very long experience working with global investors, prior to you assuming charge of this mutual fund here. You made the point about, the massive pullout that happened and how it got balanced by domestic investors. And in the last few days, we've seen a very small amount compared to that coming in and seeing this kind of a, rise up. Under what circumstances and what's your forecast by when you see them coming back into the country? We've heard a lot of logic about why they pulled out. But given the current situation and the way things might evolve, and as you mentioned about India being a shining story in all of this, do you see enhanced inflows coming in from them? Because if that happens, then we could see probably a further significant rise going from here.
Right. So, Vivek, I think like you rightly explained, I think the argument for why they pulled out, I think that was very clear. I guess the question now is that argument and the risk-off story now over? And are we now getting back into a risk-on sort of phase where emerging markets should do well, global equities should do well, etc.? And, are we there yet is really the question. And I guess, the short answer is it's probably too early to call, is the way I would look at it. And let me share why. For most global investors, global allocators, really the question is, what is your assessment of risk going forward? And if you think interest rates do have a reasonable amount of upside still left in your home markets, domestic markets, and in the currencies that you're more convinced about, then, why bother with taking more risk in one sense? So it's really then, to some extent, an expectation of how much further the Fed as well as, the European banks will raise interest rates. And what's your opportunity cost there? Let's keep in mind, a lot of foreign investors do play with leverage. So what's the cost of capital is also a big determinant in what expectation of returns you will have. So if the argument, or rather the assessment, becomes that, actually the Fed guidance of just another 50, 60 basis points further from here is accepted by the market and the bulk of the market, then you can start doing the anchoring that you need in your portfolio to say, okay, therefore my fixed income portfolio will yield so much, and this is the cost of leverage I can assume, and let me then go back to searching for growth. And when you search for growth, I think emerging markets should be beneficiaries, because like we just discussed earlier, growth in developed markets looks a lot more challenged than in emerging markets, including India. So even while, on a relative basis, when you look at the charts, even while the India forecast has been reduced from 9 to 8.2 to now 7.4%, it's still significantly higher than the rest of the world and most other major economies. So the point is that the first anchor we have to go past is the interest rate expectation now set for global investors? Once that is set is when I think a more steady slash more longer term view on emerging markets could emerge. And that's when you might expect that people will look for growth at a reasonable price. If emerging markets offer a good equation at that point in time, adjusted for currency costs, keep in mind that's another variable that we have to be cognizant of, then certainly one should look at that next wave of flows coming back. Whether last month is representative of a real trend change or not, I think it's too early to call.
Vishal, when we talk of mutual funds, we tend to focus a lot on equities, but there is the whole debt category, which is equally important, if not more, for retail investors, especially. Now that we are in a, and we've been now for a few months in a, rising interest rate regime, both in India as well as globally, how and what would your advice be to debt mutual fund investors in terms of, on the one hand, their FD rates go up and there is a logical, reason to say, okay, let me go back to FD. But on the other hand, we've been trying to tell people that a debt mutual fund is far more tax efficient, a better way to park your money in a, relatively safer asset. The rising interest rate, how do you see that impacting debt mutual fund returns? And what should an investor in a debt mutual fund be doing at this point of time?
Right. So Vivek, I think the traditional wisdom for most people, most advisors even, has been that when interest rates are going up and when you're getting into that cycle, you have to protect against mark-to-market losses, and therefore you reduce your duration risk, and try and sort of go through this phase where you can really not have too much of capital loss because of mark-to-market impact, right? And therefore you move to the less than 1 year bucket and keep money safe by and large, and don't venture out. Now this cycle, especially over the last couple of years, I would say, while that conventional wisdom may have been true in previous cycles, may not be true now. And the reason we say that is because that conventional wisdom works reasonably well when yield curves are reasonably flat. When your cost of holding short term versus holding medium to longer duration is not disproportionately off, it's a flattish yield curve. So if, for example, if I'm holding 6-month duration paper versus going, let's say, 5 years, if the entire increase of carry I can get is, let's say, 100 basis points, which is typically been the sort of case in the past, then the mark-to-market impact is actually going to be much more than the carry benefit I have. In this cycle, the argument we've been making for some time now as a house is that the steepness of the yield curve actually gives you a lot of protection, much more than what you've ever seen. So that's point number one, that actually it does make sense for you to take that risk and be in the medium to longer duration because you are getting paid for it. So that's the math you have to do yourself and see that actually by holding very, very short end, the cost of or opportunity cost of that money that you're keeping at the short end is actually more than paid by going a slightly longer duration because of the yield pickup you get. The second is that conventional wisdom also seems to suggest that, let's wait for the RBI action and then I will invest. So let's wait for RBI to keep increasing rates till the end of the cycle, and then I will probably take a duration call, and that's the best time to get it. Now, guess what? The market anticipates what the RBI and generally what the shape of the curve will be. So the market's not waiting. So even before the RBI made the first move of increasing repo rate, the market had already begun to go up. Between last year and I think by November or so, it had already moved up about 50-60 basis points. The market at different points of the curve had already moved up almost 200 basis points. So the market anticipates is the other thing you have to keep in mind. And sometimes what happens is that with different players reading different commentary as well as data points, it can over anticipate and therefore swing too much to the extreme as well. So while eventually, we don't know as yet, but let's say the RBI eventually takes through the cycle as an argument, let's say it may take as an illustration or an argument, let's say it takes it up by only 150 basis points or so from the bottom. The market at points in time may have discounted it by maybe 225 to 50 because at points in time you think it will be more aggressive than what you eventually did. So our view is that the current 4 to 6 year gilt yield is actually very, very attractive. And waiting for too long and keeping money at the shorter end and keeping money and saying, oh, I'll wait for the yields to go up and then invest and then commit some long-term money may actually have too much of a holding cost versus actually getting the yield you want. More practically, Vivek, if 6 months back we had asked most fixed income investors that, what return would you be happy with? These were times when fixed deposit rates with most banks were between 4.5-5%. So they would say, 4.5-5 looks very low, but I'll be happy with 6. 6.5, I'm okay because long-term inflation I'll at least be able to sort of be in line with or beat, and that's good enough. Guess what? Actually, at the 4 to 6 year point, you are getting much more than that with gilts. So without taking any credit risk, if you're able to get that level of yield on a, like you rightly mentioned, through a mutual fund product, it's very liquid and it's very tax efficient. And it's very low cost with some of the gilt index funds that many fund houses, including us, are offering at a very, very cheap or very cost effective manner. If you can get a gilt, hold it to maturity and hold it for a reasonable period of time, and after indexation earn much more than what you anticipated with fixed income, I would say, what are you waiting for?
Vishal, thanks to the effort of people like you, AMFI, your industry, there's been a lot of awareness built over the years, and we've seen record SIP numbers, even during, the COVID years. We still are in COVID years, but even during the worst time. How do you see those numbers changing? You travel, you go to the ground, meet investors, your teams are out there talking to investors. Do you see a greater awareness now spreading to beyond the metros, beyond, to the smaller towns and cities, and people wanting to invest more in equities through the SIP route? What's your reading of the situation?
Vivek, I am of the firm view that these 2-3 trends that we've seen in the country over the last decade or so are here to stay for some time. The first trend is financialization of savings. As we all know, India has always been a land of savers. We've had great savings rates. But a lot of that in the past used to go into real assets, gold, etc. And the amount coming to financial assets was relatively small. Actually, it was less than 50%. Over the last decade or so, you've seen more and more financial savings. So clearly, with the newer generation of savers, I think the benefit of saving money and saving money through financial assets, regulated assets, is definitely a trend that will continue. And within this pool of financial savings, what we are also seeing is a lot more of the, in a sense, growth assets, assets that are intending to beat inflation over a long period of time, both with equity as well as mutual funds, is becoming a larger and larger proportion. So that's another trend that we think will continue. So that's at a macro level. We think that is a fairly well-established now trend. And maybe potentially over several decades, you will see that benefit. Now, of course, it has a lot of follow-through benefits for the economy as a whole, as we all understand. Now, what does happen often is that you will see some amount of volatility in those flows based on immediate experience of the new investor. So two things are happening. One is that, the experienced investor, people who came in, let's say, in the early 2000s, late 90s, etc. Those investors are now seasoned. They've seen how cycles play out, and the fact that when you have a down cycle, actually when you increase your allocations that time, your probability of making even better return in the future actually goes up. So many of them have done that, and you've seen that in successive bear markets or cycles. That sharp correction often yields a lot more investment lump sum type and SIP increases rather than the other way around. So that's one group of investors who've now gone through cycles and understand. The newer set of investors, and a lot of growth, rapid growth has happened over the last several years. Those investors that are still going through the first cycle can often get a bit, dejected, or maybe it's not meeting the expectations. And that's where a lot of the data as well as the hand-holding through our distributors, advisors, media partners, etc., comes in handy. Because I guess it is absolutely proven across different, very, very diverse pieces of data that when your past returns actually look negative or very lackluster, that's actually a very good indicator of your future returns being very attractive. And we've done these studies. We put this out in the market for various periods of time, because people get doubtful or unsure when suddenly you find your account statement showing that actually you're below your capital invested, or your returns are now looking like 2, 3, 4%, and you were expecting double-digit returns, right? So that's the time when you start doubting the concept of SIPs and say, oh, should I actually stop my SIP or do something about it? And that's when we have to remind them that, look, every time that your SIPs have turned into negative returns, your probability of earning very healthy returns over the next 5 years is actually very high. That's what cycle after cycle has shown. And what I'm happy to see is that through this last year, when SIP returns did become negative, if you remember at the end of June, that was beginning to happen, we did not see a dent in the SIP flows. So it is also telling us that the market is maturing. Even the new investors this time seem to have got the message that, doing anything abrupt or, taking any knee-jerk reaction on your SIPs or your mutual fund flows, just based on past returns or a market correction, may not be the right thing to do. And therefore, a long answer to your short question, but I don't think that we should expect too much of volatility in retail domestic flows, despite the turbulence that we think the market will often, pose, in fact.
Are you and your fund managers bullish on equity for the next 3 to 5 years?
We're absolutely bullish on growth in India. And I think growth in India will bring a lot of, opportunities for investors. Of course, what ends up happening is that, different phases provides opportunities at different, sectors. And therefore, some amount of sector rotation, some amount of, theme changes, etc., will happen. But again, going back, we discussed the concept from a global allocator standpoint, right? So what are your opportunities and where is the growth? And if India as an economy is going to offer you, let's say, anyone's guess, but people are talking about 6 to 7% real growth, add inflation on top, and add on top of that, that's at an economy level. So profit growth, the profit pool with listed companies available, can still be in mid-teens. And mid-teen growth, even without any PE expansion. So if you look at, let's say, median PE or mid-level PEs, still gives you double-digit returns. Why is that something that is not attractive to you is the question I would ask you. Of course, if you're coming in because you expect 40% return every year because that's what you made last year or, the year before that, then you're just being, too greedy. And I would say, therefore, moderate your expectations. Look at alternatives. Of course, there is a value of fixed income and providing stability to your portfolio. And we just discussed, it's as good a time as any to capture the yield that is available without any risk because there's Government of India securities. But on the other side, for a growth part of your portfolio, even if you hold P's steady at current levels, If profit growth in corporate India is expected to be mid-teens, then how wrong can you really get it? Is another way to look at it.
It's been a pleasure talking to you, Vishal. Thank you very much for taking time out and coming and guiding 300 million users of Daily Hunt. Thank you very much. And I look forward to many more interactions with you in the future. Thank you and wish you all the very best.
Thank you, Vivek. Pleasure being here and great having this chat. Thank you.
Thank you.